Gene, do you make portfolio adjustments now that we've seen the shift in the fixed income space?
Yeah, thanks, Tom. I think this is an important time, actually, for the bond market. We didn't get a lot of new information from the Fed last week. We thought the taper was coming, the market did, and the taper is certainly coming. But I think what we got, which was a surprise, is that we didn't get this separation in the language as strongly as we expected from the tapering to the rate liftoff. And Powell told us at Jackson Hole that there would be a substantially more stringent test for rate liftoff, but what we saw was really one and the same. So that's, I think, putting a floor under how low yields can go. Do you adjust portfolios based upon that? Well, I think the good news from what we've seen so far is that we've seen rates up with credit spreads tighter and with stock prices higher. So it hasn't been the breakdown of diversification. This has not been the 2013 taper tantrum. So the short answer is no, don't revisit your portfolio strategy. Just be a little bit more defensive on the interest rate side.
Gene, where on the curve has got your attention right now? We've seen a real adjustment on 5s, seen a real adjustment on 10s, 30s. What's got your attention at the moment?
Yeah, John, actually, we feel more comfortable with the 5 to 7 year part of the curve. I think if you look at what is priced for Fed expectations, it's actually pretty reasonable. It's pretty much in line with what the Fed itself is forecasting. It's that longer end of the curve where we're a little bit more nervous. And if there's an anchor or sort of a force of gravity out there, it's relating the 30-year yield to the Fed's long-run dot, which sits there at 2.5%, still 0.5% away from where we are today on the long end. So I think the gravitational pull will be for the long end yield to move higher, and we're a little more defensive there.
You think we can get back to 2.5? You think we can reach that long-term dot over at the Federal Reserve? You think that's ultimately achievable, Gene?
Absolutely. You were talking earlier, can we get real yields back to zero? I don't think it's a 2021 event, but I think that's the path that we're on. And if we get there more quickly, it's the old adage that speed kills, and speed kills in the bond market, because eventually that's what pinches financial conditions. So it's not that rates can't move higher, but it's that velocity, that speed with which we saw yields rise back in the first quarter that was really starting to pinch. So if we can see a more gradual move, that would be much more digestible at this stage.
Gene, how much does the international picture color your call for the 30-year bond yield, given what we're seeing over in Europe?
Yeah, thanks, Lisa. It might actually be more important, to be honest with you. I think, again, last week, the new information from the Fed was more in body language and posture than anything substantive. But if we listen to the Bank of England and the fact that they're pivoting to a more hawkish policy, that we might see, a removal of liquidity from the European Central Bank, I think that global backdrop actually plays a significant role in this idea that the wave of liquidity is starting to wane, and I think that doesn't support the long end the way it has in the past.
Gene, what if international buyers step back to the degree that they did in the last 10-year reopening that we saw, and domestic buyers have to pick up all the slack for the Treasury market? What happens then?
Well, I think that's been a debate for a decade plus now, and that risk is always there. I think the pressure release valve is probably not the yield as much as it is the value of the dollar relative to other key crosses there. So I think that's one where you don't want to stick your neck out too far from a currency risk perspective. I don't think that's going to be the key driver of yield and treasury prices here, because what we're seeing is that currency hedged treasury yields are still actually pretty attractive to other developed market buyers.
Let me ask you this, and on the buy side, you're at a whole different viewpoint on this. What is a 10-year yield in your head where you signal what James Bullard would call a regime shift? Are we here, or is it a higher yield?
I don't think we're anywhere near a regime shift yet, and I think we'd have to be in a place where it looks like the market's really getting disconnected from what the Fed is saying. If you look at what the Fed's projecting, we're talking about whether or not we're pricing in a couple, 3 hikes out to 2023. That's pretty modest. That's pretty reasonable. And the market's not far away from the Fed there. If we start to see the market really push the Fed higher, I think that becomes problematic. That's your James Bullard regime shift. And I think we're a long way from there. But that's an environment where 10s are well above 2%.
Hey, Gene, always good to catch up. You're fantastic. Gene Tannuzzo there.